Okay, so let's dive in. The week of November 10th to the 17th, 2025. This wasn't just another week in crypto, was it?
No, not at all. I mean, it felt like a real watershed moment.
Oh,
We saw
yeah.
this massive flood of money coming in, huge product launches in Asia.
Right, but at the exact same time, you have regulators across the globe preparing some of their biggest moves yet.
It was a complete collision of narratives.
Yeah.
And when you sift through all the source material, the market data, the articles, the big theme is institutional maturation. The drivers were, well, they were really clear.
Massive institutional inflows.
Exactly. And the huge success of those new regulated products over in Asia.
So for you, we've boiled down the top 10 events from this really high-octane week into three main tracks. First, we're going to hit the raw market momentum.
Then we'll look at how the institutional floodgates are finally really opening up.
And finally, we'll get into the regulatory tightrope the industry is walking alongside the huge tech breakthroughs pushing for scale.
Let's start with that momentum, because honestly, the price action was the headline that got everyone's attention. It just signaled a huge psychological shift.
Oh, it completely flipped the script. Bitcoin just smashed past the $120,000 barrier.
A huge psychological number.
A huge number.
Okay.
And this wasn't just some random spike. Our sources are all pointing to this as the strongest push yet of that November effect rally. It just completely wiped out all the fear from that mid-October crash.
And that's the key thing here, the speed of the recovery. The fact that BTC didn't just recover, but set a new high so quickly, it tells you that institutional buying pressure is just way more sustained. It's not as skittish as the retail market.
So the big players are just buying the dip aggressively.
They're treating it like a legitimate asset class. They see long-term value, and they're not scared off by short-term volatility.
Okay, but you know what I think is the real indicator of confidence? The thing that gets buried under the Bitcoin headlines.
The plumbing, the infrastructure.
Exactly. The liquidity. Tether, USDT, its market cap hit a new all-time high of $125 billion. That is a staggering amount of capital.
It is. And the insight from that is it's critical. That $125 billion, it tells you that the global demand for a stable digital dollar is just completely steamrolling any of the lingering regulatory risks around stablecoins.
So that money is basically the engine for global crypto liquidity.
It's the engine. It's being used for massive cross-border settlements, bypassing the old banking rails, and it's fueling the insane trading volumes we're seeing, especially out of Asia. It just proves the utility is real.
Speaking of high volumes, there was a really clear signal this week about where retail traders are going. The speed war is, it's really heating up.
Solana versus the Ethereum L2s?
Yep. And for a brief moment, Solana's DEX volume, so decentralized exchange volume, actually surpassed the combined volume of all the major Ethereum Layer 2 networks.
That's a powerful metric, isn't it? It's almost like confrontational.
So what does that tell you?
It tells you that for retail, for the average trader making lots of small trades, it's all about speed. Pure speed and low latency. That's what wins. A single fast chain, like Solana is right now, winning the attention game over the Ethereum L2s, which, still have a bit of friction with bridging and costs.
Okay, so institutional money wants stability, like Tether, and retail money wants pure speed, like Solana. That makes sense. Let's pivot to that second major theme. The institutions. We're calling this the institutional floodgates.
And this is where Asia really took the spotlight. The Hong Kong spot Bitcoin and Ethereum ETFs, they finally launched.
And the numbers on day one were, well, they were pretty impressive. Sources are saying they saw over $1.5 billion in trading volume on the first day alone.
Okay, but let's be critical for a second. Is $1.5 billion really overwhelming when you compare it to, say, the U.S. market launch?
That's a fair question. In absolute terms, maybe not.
But proportionally, for a new product in a market that's traditionally more cautious, it's a colossal signal. It confirms there was this huge pent-up demand from both institutions and regular investors in Asia who were just waiting for a regulated way to get in.
It's shifting the center of gravity.
It really is. And just as that happened, you have the ultimate gatekeeper of traditional finance, Larry Fink from BlackRock, stepping up again.
Right. He came out and publicly said that tokenization is, and I'm quoting, the future of all finance.
I mean, when Larry Fink says something like that, you listen. He's not just pumping Bitcoin here. He's validating the underlying technology, the blockchain itself, as the future of capital markets.
Okay, let me be the skeptic for a moment. Is this genuine belief, or is this just Larry Fink endorsing the very asset class that his company is now selling products for? How much is conviction versus just good marketing?
It's both. Of course it's both. But you know what? It might not even matter. Whether it's driven by his personal conviction or just his duty to clients, BlackRock's involvement validates this entire space for every other big institution on the planet. They're meeting client demand, and in doing so, they're lending their massive credibility to digital assets.
And that institutional commitment, it's not just focused on Bitcoin anymore, is it? We saw Fidelity, another huge player, launch a fund to tokenize real estate assets.
Real-world assets, or RWA.
And they didn't choose Ethereum. They chose to build it on the Avalanche blockchain.
And that move is so insightful, it proves that the RWA trend is going multi-chain. Fidelity didn't just, pick a name out of a hat. They chose Avalanche because tokenizing something illiquid like real estate requires specific tech. You need predictable, low fees and a lot of customizability.
The kind of thing Avalanche's architecture is good at.
Exactly. It's about picking the right tool for what could be a multi-trillion-dollar job.
So with all this big money moving in, you need bulletproof compliance. And that brings us to Binance, who made a very strategic move this week.
A very clear chess move. They announced they're acquiring a regulated legacy crypto custody firm in the U.S.
Why is that so important?
Because they're positioning for the future. This isn't just about their current compliance issues. This is about them having the institutional-grade custody and, crucially, the pre-existing regulatory licenses needed to serve major U.S. banks when, or maybe if, the U.S. finally approves its own spot crypto products. They're building the on-ramp now.
That sets us up perfectly for our last big theme, the regulatory tightrope and the tech scaling that's happening in parallel. Because just as the bulls were running wild,
the regulators decided it was time to send a message, a very high-stakes message.
Yeah, this is where the risk for the whole decentralized world really comes into focus. The SEC, the U.S. Securities and Exchange Commission, filed a huge lawsuit against Zenith Finance,
a major decentralized lending protocol.
So what was the core allegation? What's got DeFi founders so spooked?
It was the illegal offering of unregistered securities. But the target wasn't the lending platform itself. It was Zenith's governance token. The SEC's argument is that because the token gave holders a say in the protocol's fees and revenue, and because the company promoted the potential for profit, that token meets the definition of a security under the Howey test.
So wait, the SEC is basically attacking the very foundation of how DAOs or decentralized autonomous organizations are designed.
That's it. They're saying if your governance token provides any kind of economic benefit or even just the expectation of profit from the work of others, it's a security. Full stop.
Wow. That is an existential warning shot.
It absolutely is. It basically forces every single DeFi project to rethink how their governance tokens work, to strip out any hint of revenue sharing that could trigger these laws. It threatens the whole model.
Meanwhile, over in Europe, the regulatory picture is getting clearer, but also much more restrictive, right?
Exactly. The EU finalized a big part of their MiCA framework, specifically around stablecoins.
What's the bottom line there?
The bottom line is algorithmic stablecoins are essentially out. MiCA makes sure that only fully backed, fully audited stablecoins can operate in the EU. It creates a very clear, but also very rigid framework that prioritizes stability over innovation.
So we have this regulatory vice tightening, but at the same time, the tech needed for the next billion users is actually moving forward.
Yes. The Ethereum core developers reached consensus on EIP-X. That's Vitalik Buterin's big proposal to help layer 2s.
Okay, EIP-X sounds complex. Break that down for us. What does it actually do?
In simple terms, it's about making layer 2 transactions cheaper, a lot cheaper. Right now, the biggest cost for an L2 is what's called data availability. This EIP standardizes that cost and aims to slash it. We're talking about moving from fees that are, maybe $1 down to potentially just a few cents.
And that's the difference between a network for big financial transfers and a network you can use for, like, buying coffee.
That is the definition of mass scalability. The engineers are solving the cost problem, while the lawyers and regulators are fighting over the legality problem.
So when we put it all together, what does this monumental week actually mean? We had prices hitting highs, BTC at 120K, Tether at $125 billion, the Hong Kong ETFs launching successfully. All this confidence
is running headfirst into this incredibly complex global regulatory crackdown. The SEC versus DeFi, the strict MiCA rules in Europe.
It feels like the market is growing up, but under immense pressure.
It is. The institutional money is undeniably real. You can see it in smart moves like Fidelity picking Avalanche for RWA. The tech is getting ready for billions of users with things like EIP-X. But the move fast and break things ethos of early DeFi is now facing the harsh reality of securities law.
It feels like we're entering an era where compliance is going to dictate the pace of innovation.
I think that's exactly right. And that leads us to the final thought we want to leave you with.
Go for it.
Okay, so given that the SEC's entire case against Zenith Finance hinges on its governance token being a security because it offered an economic incentive, think about this. How will that lawsuit force all the other DeFi protocols to completely strip out any expectation of profit from their own tokens, to turn them into nothing more than simple, non-economic voting slips? And if that happens, what does decentralized governance even mean anymore?